What's up, you guys? Welcome back to the Average Joe on Money financial channel, and in this video we're getting right to the point here. We are talking about Fidelity index funds. More specifically though, we're talking about Fidelity exchange traded funds. And if you guys have watched my channel at all, you know that I definitely prefer exchange traded funds over indexed mutual funds, though Fidelity does have a great offering of indexed mutual funds. So what I want to do for you in this video is walk through exactly how to understand all that Fidelity has to offer with respect to exchange traded funds. We'll talk about, just to make sure everyone understands, what is an exchange traded fund as compared to a Fidelity indexed mutual fund. We'll look at what Fidelity has to offer. We'll look at their partnership with iShares and the ETFs that are also available on their website. We're looking at this as well from a complete beginner perspective. So we'll also talk about the Fidelity exchange traded funds that you probably, as a new investor, want to avoid just because they're a little bit more complex and potentially even more expensive to own. So we're just going to get started right now. Make sure you guys click that subscribe button to be alerted to all future videos. On this channel, we talk a lot about investing. We talk about exchange traded funds. We talk about indexed mutual funds. We talk about index funds. We talk about investing with respect to dividends and my dividend portfolio that I have with Fidelity. So as you can see here, we are on the Fidelity website, and this will be your landing page if you come to Fidelity's website. Now, the great news is you don't have to have a Fidelity brokerage or retirement account to invest in Fidelity exchange traded funds. First thing you need to do is go over to investment products and then click on ETFs, which are short for exchange traded funds. Just to make sure you guys have a firm understanding on what an exchange traded fund is, it's very similar to an index fund in that when you purchase an ETF, as it says here, you purchase a basket of securities you buy or sell through a brokerage firm on a stock exchange. So when somebody talks about a mutual fund or an index fund or an exchange traded fund, they're essentially talking about the same thing with potentially a small difference. With a mutual fund, you are buying a basket of stocks or potentially bonds or maybe even a mixture of the two. And you purchase that investment from a brokerage company. And at that point, you essentially have immediate diversification of your assets. An indexed mutual fund is a passive mutual fund. The main difference there is with mutual funds, you have an active fund manager who is making the buy and sell decisions in the portfolio. If they feel that a certain stock needs to be purchased because it's going to grow, they're going to purchase it. They're not going to ask you for your recommendation. They're just going to do it. And as part of having an active fund manager, there is inherently more costs involved because active fund managers need to get paid. So the expense ratio, which we'll talk more about, is higher for a mutual fund than it is for exchange traded funds generally, or an indexed mutual fund. The types of investments you're going to see in an exchange traded fund and an indexed mutual fund are pretty much the same. They don't have an active fund manager making buy and sell decisions. Instead, like I said, they're passive. They generally will track an index. So instead of trying to beat the market, they're really just trying to match the market. However, there is a fundamental difference in how an exchange traded fund trades in the open market and how an indexed mutual fund trades. Take, for example, here the Fidelity Total Market Index Fund. This is a mutual fund. Ticker symbol here is FSKAX. It tracks the total stock market. It's a great investment. And let's say today you want to buy shares of this mutual fund. Well, you could go on here and you can buy shares at 9:30 or 10:30 or 11:30 in the morning. Doesn't matter. Doesn't matter what time you put that order in today. You're not getting that price at that very moment in time. With all mutual funds, both passively traded index funds as well as the actively managed mutual funds, the price you get is only the price at the very end of the trading day, after the investment company has had an opportunity to reconcile all of the purchases and redemptions of the mutual fund. So instead, you get that price at the end of the day. So if it was really tanking and you wanted to get a good value at the beginning of the day, you're not going to get it unless it ends the day at that price. Consequently, with an exchange traded fund, you do get to capture that value, because an ETF is bought and sold, like it says here, like a company stock during the day when the stock exchanges are open. So if you want to buy a stock or an exchange traded fund at 9:30 because you like the price, you can buy it right then and there at that price. Same thing at different points in the day. The ETF has a ticker symbol, and you can easily obtain the intraday or the price throughout the day. However, an exchange traded fund is a little bit different than a stock, because with a stock there's a fixed number of shares available, whereas the number of shares outstanding for an exchange traded fund could change every day depending on the number of new investors that come into the fund. So the big advantage of exchange traded funds, as it says right down here, one of the reasons really why I love exchange traded funds for my brokerage account as well as for my Roth IRA, is they're easy to trade. Right? You can buy and sell any time of the day, unlike most mutual funds that trade at the end of the day. And most ETFs are index-based. As you're going to see here, Fidelity does offer both index-based or passive ETFs, as well as actively traded ETFs. And as it says here, they are more tax efficient. Now, generally for the average Joe out there, this isn't going to be a primary concern for you, but ETFs typically generate a lower level of capital gain distributions relative to actively managed mutual funds. Now, ETFs do have disadvantages. Many brokerages these days don't even have a cost to trade shares of an ETF or a stock, which is great. They are liquid though, and many people argue that you should own indexed mutual funds as opposed to ETFs because it will encourage you to hold on to the investment longer. And I can't necessarily dispute that. It is a lot easier to move your investments and change them with ETFs, but that doesn't mean you have to. You can own an ETF for the long term, for many years. You don't have to sell it actively. Furthermore, I love ETFs because you can purchase them from any brokerage, whether you have your account with Fidelity, or you have it with Vanguard, or you have it with iShares, you have it with M1 Finance or Robinhood. You can purchase an ETF from any company. You can own Vanguard's ETFs. You can own the Fidelity exchange traded funds that they offer. You can own anybody's ETFs within any brokerage, and that you can't say that with respect to an indexed mutual fund. Oftentimes, if you do want to purchase a Vanguard mutual fund, well, you have an account with Fidelity and vice versa, they're going to charge you a fee to purchase those indexed mutual funds from a different company, and that fee is not cheap. Somewhere it's in the range of $50 to $100. So let's talk a little bit about Fidelity exchange traded funds and what they offer. They do offer low cost passive exchange traded funds, which are indexed ETFs, and they also offer some actively traded ones. And again, we're going to be approaching this from the complete beginner perspective. You're new to investing, you're new to your retirement account, you're new to Fidelity investment products. So if you come in here to Fidelity's website, you go to investment products, you click on ETFs, it's going to take you to, well, this page. Okay, and if you scroll down here, you're going to see that they have some options here. Fidelity has a partnership with iShares. We'll get to that in a second, where you can choose their exchange traded funds relatively easily. If we come over here to Fidelity ETFs, let's go start there. You'll notice that they have a lot of different options here. They've got active equity ETFs, factor ETFs, sector ETFs, stock ETFs, and bond ETFs. And depending on your situation and your comfort level, you can make a choice from these options. Again, from the complete beginner perspective, a lot of these are not appropriate. You don't need to utilize active equity ETFs. Again, these are using an active fund manager. So if we're looking at the active equity ETFs first, you can see that they offer three different options here. They've got the Fidelity Blue Chip Growth ETF, FBCG, then the Fidelity Blue Chip Value ETF, and the Fidelity New Millennium ETF. And you can see that the investing strategy is interesting here. We've got this one here, which invests in domestic large cap companies with earnings growth potential and sustainable business models that may be mispriced by the market. Then we've got this one here that purchases large cap value companies that are currently priced lower than their expected long-term value. And then the New Millennium ETF invests across sectors and market caps in emerging growth stocks that may benefit from opportunities created by long-term changes in the market. That all sounds fine and dandy, but one thing you need to know about any type of actively managed investment is there's an additional cost involved. Take, for example, FBCG, which is that Fidelity Blue Chip Growth ETF. If we look down here, you're going to see, you zoom in right here, the net expense ratio. So an expense ratio is the cost of the management company to manage the investment on your behalf. This is a relatively new ETF. It was opened in June 2nd, 2020. It's actively managed. This expense ratio, 0.59%, is the annual fee for owning this investment. So whether this ETF does well, does amazing, or even if it loses money, they're still going to charge you this fee. If you pull up your calculator, you can see that, let's say you have $1,000 invested. You just take that $1,000 invested and you multiply it by 0.59%, or 0.0059. Means that every year they're going to charge you $5.90, no matter how well the fund does. They're not going to give you a break if they lose money. They're not going to charge you more if they make money. $5.90 for every $1,000 you invest. Now that doesn't sound like a lot of money. I can appreciate that. But the numbers can become staggering over time. Let's say you stick with this company, or you already have a lot of money to invest. Let's say you've got $100,000. Multiply that by 0.59%. Now we're talking $590 every year just to own the fund. Again, regardless of how it performs. For FBCV, the Blue Chip Value ETF, again, it's got an expense ratio of 0.59%. And the same thing for the Millennium. I can't help but think Millennium Falcon from Star Wars when I see this, but Fidelity New Millennium ETF, FMIL, also has that net expense ratio of 0.59%. The reason why I bring up this expense ratio is Fidelity and many other companies have ETFs that match the index and have a much, much lower expense ratio. You're taking a risk anytime you want to try and beat the index. You want to try and beat the S&P 500 or the Dow Jones Industrial or whatever market you're trying to beat with an actively traded index fund or ETF. Anytime there's an actively traded fund, they're trying to beat the market. They try to justify their expense ratio by outperforming the market. And some do occasionally, but very few can consistently do that. So from a complete beginner or an average Joe perspective, relatively new in investing, I find it very hard to recommend these types of ETFs because they have so many other great options available for the complete beginner. Let's talk a little bit more here. So if we come up here, we can see factor ETFs, and these are kind of similar to active equity ETFs. So with a factor ETF, they are helping you hone in on specific types of investments. So you've got a lot of different options here. We've got the multi-factor ETF, stocks for inflation, the small to mid-sized multi-factor ETF, value, international high dividend. So if you're looking for a dividend ETF, and there are a lot of great options out there, Fidelity does have a few options here with the international high dividend, which focuses on international companies, the high dividend ETF, and then the dividend ETF for rising rates. And they've also got a few options here as well, the high yield factor, momentum, quality. All of these are making a bet on a specific type of investment rather than tracking the overall market. I got to be honest with you guys, I don't feel like there's a lot of value in coming in and owning the Fidelity Value Factor ETF or owning the low duration bond ETF. Depending on your current investment profile, that could be different though. If you are a young investor, by all means, I feel like a lot of these are just overhyped and not necessarily a good fit for you. That being said though, if you are an older investor, maybe you're closer to retirement, you're very uncomfortable with the idea of losing money, whether you have a lot of time to invest or not very much time at all, well then potentially owning bonds or exchange traded funds that track very stable investments would be a better fit for you. But if you have a lot of time to invest, then these types of investments are just unique plays on different sectors of the economy, which may or may not be a fit for you. On a future video, we'll talk more about Fidelity Dividend ETFs and which of these potentially could be a good investment for you. But right now, though, the focus for the complete beginner is not on these types of ETFs here. Let's talk a little bit about sector ETFs. So there are different sectors of the economy. You've got the financial sector of the economy, communication, consumer staples, consumer discretionary, energy, healthcare, lots of different sectors of the economy. And Fidelity, like Vanguard, as you can see here in this comparison, Fidelity does offer the ability to focus in on one or more specific sectors if you feel as an investor that that sector is going to outperform the overall economy in the future. Take, for example, the Information Technology ETF for Fidelity. Ticker symbol here is FTEC. The Fidelity MSCI Information Technology Index ETF, FTEC. You'll see here, one of the first things I want to point out, this is an indexed ETF or passive ETF. And as a result, their expense ratio is much, much lower. You can see here, 0.08%. And remember that the active equity ETFs are charging 0.59%. So if we pull up our calculator here, we take $1,000 and we multiply it by 0.08%. For every $1,000 invested in this ETF, the annual charge is only 80 cents. It's a lot less than the $5.90 that the other ETF is charging. Again, regardless of how it performs. So we know that Fidelity indexed or passive ETFs have lower expense ratios, but as you can see here, this ETF seeks to track a specific benchmark index, the MSCI USA IMI Information Technology 2550 Index, meaning it's trying to provide investment returns that correspond with a specific index, not beat the market, just match the market. So if we scroll down here, you can see here that the companies that are owned in this ETF are in the technology sector of the economy. So we've got Fidelity, Microsoft, Visa, NVIDIA, MasterCard, PayPal, Adobe. And you can see here that there are 331 different companies in this portfolio. Apple takes up almost 21% of the ETF. Then you got Microsoft at 15%. So just those two companies represent 35% of this ETF. But the ETF does provide a significant amount of diversification. And you can do this with any of these sector ETFs, communication services, consumer discretionary, consumer staples. In a future video, we'll talk more about Fidelity sector ETFs, but one just note here, with comparison to Vanguard sector ETFs, they do offer a lower expense ratio at 0.084% compared to Vanguard at 0.10%. Again, from a complete beginner perspective, sector ETFs are a unique play on the economy and offer additional risks that you may not be comfortable with. Sure, you could invest in the communication services ETF or the information technology ETF, and these ETFs could outperform the overall market, perhaps by a very large margin. But the risk is that you focus on one or two sectors of the economy and they do not perform as well as the overall market, or you choose the wrong sector ETF. Maybe healthcare just explodes in growth and you're left behind because you only invested in the information technology and communications services ETF. So Fidelity sector ETFs have very low expense ratios and they offer the opportunity for the average Joe investor out there to invest in specific sectors of the economy, but that is not necessarily a good fit for a complete beginner out there. Let's see what other options we have here. Stock ETFs. So you'll notice here that there are a lot of different stock ETFs, and it includes some that we've already talked about. For example, these sector ETFs here, and the new actively traded equity ETFs up here that we've already talked about. And some other ones down here. The big problem that I have with Fidelity ETFs is that they don't offer a general Fidelity S&P 500 ETF like Vanguard does, like iShares does. They offer a lot of different unique opportunities, but only one major index do they track. They track the Nasdaq Composite Index, ONEQ. So we've got Fidelity ONEQ. It tracks the Nasdaq Composite Index. And so you've probably heard of the S&P 500. You can see it right up here. It's an index that is tracked. The S&P 500 includes 500 of the largest companies in the United States based on their market capitalization, which said plainly is how much the company is worth, market capitalization. But you can also see that there's the Dow Jones Industrial Average, and then you've got the Nasdaq here. The Nasdaq is definitely tech heavy, meaning that all things being equal, there are a lot more tech companies in the Nasdaq index than the S&P 500. Now, the Fidelity Nasdaq Composite Index ETF does have an expense ratio of 0.21%, which is a little bit higher than I like to see for an indexed ETF. But that being said, this specific ETF has performed very well. If we scroll down here to the quarter end average annual total returns, the 1-year return, 42.11%. The 3-year return is 21%, 5-year return 20%, 10-year return 18%, and over the lifetime since 2003 when this ETF was started, it has returned 12.2%. You can see that the Fidelity Composite Index has 1,032 holdings, but of those 1,032, the top 10 holds 45.77% of the total holdings. Very top heavy. You've got Apple holding 11%, Microsoft holding 9%, Amazon holding 9%. So we're talking about 33% here. So we're almost at 30% of the index with just the top 3 holdings. Then you include Facebook and Alphabet, which is Google, both their Class A and their Class C shares. You've got Tesla, Nvidia, PayPal. We take all that into effect, we've got 45% of the total holdings. Now you still have 1,000 holdings and you do achieve a significant level of diversification, but it is very top heavy. When you purchase shares of this ETF, you're getting a lot of the top companies: Apple, Microsoft, Amazon, Google, Facebook. You can see here that when you buy this ETF, you are getting everything in the index, in the Nasdaq index. Again, capitalization weighted, meaning that for every share of the ETF, you're purchasing, for the most part, a lot of the top companies: Apple, Microsoft, Amazon, Facebook. But you scroll down here, you're also purchasing Zoom, you're purchasing Starbucks, Amgen, you're purchasing Gilead Sciences, you're purchasing Keurig Dr. Pepper, you're purchasing all these different companies, but you can see the weighting in the index here: 0.12%, 0.11%. All the way down here, you can scroll. Very small weighting in a lot of these companies here, like Beam Therapeutics, Cardlytics, Kaiser Aluminum, Fresh Pet, Warner Music, Old National Bank. Very small weightings in this ETF. Doesn't mean that this ETF is a bad investment. It just means that it's market capitalization weighted. Means the companies that are worth the most money have the highest weighting in the ETF. Again, putting aside the sector ETFs, which from a complete beginner perspective are not a great fit, and taking out some of these factor or momentum ETFs, really the only one I would strongly look at is the Fidelity Nasdaq Composite Index from a Fidelity ETF perspective. And again, we'll talk about dividend ETFs later, but if you're brand new, you're looking to get invested in the market, the only one I'd really look here at would be the Fidelity Nasdaq Composite Index. Now, one thing I want to make note of is up top here, they talk about iShares ETFs, and Fidelity and iShares has a partnership. So let's click on the iShares ETF section right here. iShares offers the largest low-cost S&P 500 index ETF with a razor-thin, small expense ratio, 0.03%. So iShares is another large brokerage company that offers a lot of different exchange-traded funds. So if we scroll down here, we can see here that they have some options that Fidelity does not. Chiefly the iShares Core S&P 500 ETF, IVV. They also have a Total Stock Market ETF, ITOT. And they've got an International Total Stock Market as well. They've got potential income ETFs like the Core Dividend Growth, Aggregate Bond, and the Broad USD High Yield Corporate Bond. Most of these I'm not going to touch. I'm not going to touch, for me, the iShares Gold Trust or the iShares United States Treasury ETF, but IVV I'm going to click on here because that's a great option for brand new investors if you're using the Fidelity platform. Ticker symbol here, IVV, the iShares S&P 500 ETF, like I mentioned, tracks an overall index. Like we talked about Nasdaq, it tracks the S&P 500 as well. This one specifically tracks the S&P 500, which again is 500 of the largest companies in the United States. It was created in the year 2000. Expense ratio 0.03%, which means that for every $1,000 invested, it costs you 3 cents. That's it. If we look down here, we can see that this investment seeks to track the investment results of the overall S&P 500. It's not trying to beat the S&P 500, it's trying to match the overall results of this index. If we scroll down here, you can see that it's performed well. 15% over the last year, 12% 3-year return, 14% 5-year return, and 13% 10-year return. Over the life since the year 2000, 6%. And that has included a few dips in the market as well. You'll notice that this ETF has not performed as well as ONEQ, which was that Fidelity Nasdaq ETF. But that's because the Nasdaq has outperformed the S&P 500. When you purchase the S&P 500 ETF with iShares IVV, you're getting 509 different companies. Top 10 look relatively familiar, right? Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, and Visa. A newcomer to this list will be Tesla, which they will be joining the S&P 500. This will show up here once they show the 12/30/2020 holdings because they were recently added. But see, you can see here much smaller holdings in the top 10. Only 27% of total holdings. Right here, Apple at 6% versus in the Composite index, it was over 10%. Then we've got Microsoft at 5%, Amazon at 4%, Facebook, Alphabet, both Class A and Class C. If you click on the View All Holdings, you can see an entire list of... Oh, just kidding. You actually have to be a Fidelity customer here. But you know what? I want to go ahead and give you that. So hold on one moment. All right, that's much better here. So now you can see here, we've got all of the different companies in the S&P 500. Again, the largest companies have the biggest weighting. Apple, Microsoft, Facebook, Google, Amazon, Visa, MasterCard, all these companies. But if you scroll down, you can also get ownership in Kimberly-Clark, Boston Scientific, BlackRock. We've got ConocoPhillips. We've got L3 Harris Technology. Scroll down further. We've got HP Incorporated. We have Johnson Controls, Parker Hannifin. Scroll down even further. Some of these small companies down here at the very bottom of the list here. Just Gap Incorporated, Ralph Lauren, Unum Group, News Corp, Under Armour. When you buy one share of the IVV ETF, you're capturing all of these companies on a weighted basis. Again, the largest companies, the highest weighting. The other one you can look at here is the iShares Core S&P Total U.S. Stock Market, ITOT. One thing you're going to find, I've talked about this when I've talked about Vanguard ETFs, is when you compare the S&P 500 to the total stock market, again, these are both weighted ETFs, meaning that the largest companies have the highest amount of value. And remember, with the S&P 500, you had 509 holdings. With the iShares Core S&P Total U.S. Stock Market, you're going to have a significantly higher amount of holdings because it's tracking the entire stock market, both the large companies, the mid-sized companies, and the small companies. You can see the net expense ratio here, 0.03%, again, also very low. The current price per share, $85.12. If we look down here, we can see top 10 holdings. They just about completely match the S&P 500 ETF. Apple, Microsoft, Amazon, Facebook, Google, both Class A and Class C, Berkshire Hathaway, Tesla, and I talked about this in a previous video. Tesla has been in the total stock market index and not the S&P 500 until recently, which means that the total stock market has been able to capture some of the record growth from Tesla, even though they only have a 1.15% weighting in this total stock market ETF. And then you've got Johnson & Johnson and JP Morgan Chase. So very similar holdings, which is why, for the most part, the performance in this ETF tracks very closely with the S&P 500. We're at 14%, 11%, 13, 13, and 8. Very close to the S&P 500. Any one of these three different indexes are going to be a great option for you. The IVV ETF, which is that S&P 500 with iShares. You can also grab that total stock market here with iShares, ITOT. ONEQ is available, which is the Nasdaq Composite Index ETF. These are great beginner investor types of ETFs that are going to track the overall market. They're going to have relatively low expense ratios, in some cases ultra low, with the total stock market and the S&P 500 with iShares. And you'll be able to participate in the market growth. Now, of course, as you're getting closer and closer to retirement, or potentially you're getting closer to needing the money, well, then you might have to look at other options here, such as potential income sources like the dividend growth ETF or maybe a bond ETF. Again, bonds are much more safe and stable than stocks, but they also grow at a slower rate. The point of this is for the complete beginner out there, though. And when we talk about complete beginners, we're talking about simple and straightforward. And to do that, you've got some great options available. And if I were a brand new investor jumping on the Fidelity platform, wanting to use Fidelity ETFs or take advantage of their partnership with iShares and utilize their ETFs, I can't see you going wrong with the iShares Core S&P 500 ETF, IVV, the iShares Core S&P Total US Stock Market ETF at ITOT, or looking at that Fidelity Nasdaq Composite Index, ONEQ. Great options here for the complete beginner investor out there. Now, if you want to get started with Fidelity and open an account here, you can go up to their website and click on open an account. And it's going to take you through that process here where you want to indicate what type of account you want to own. Now, if you want to own a retirement account with Fidelity, they have some options available. You can own a Roth IRA, a traditional IRA, or you can roll over an existing retirement account to Fidelity. If you'd like to have your assets in a general brokerage or taxable account, you can do that down here with the brokerage account. You can also open up a 529 account to save for your children's education. Hopefully you found some value out of this video, guys. Make sure you click on that subscribe button to learn more about Fidelity ETFs, Fidelity index funds, all types of index funds, dividend stocks. We talk about all those different types of videos. We talk about all of these types of investments on this channel. And again, I'm just the average Joe investor out there. I was not born into a wealthy family. I'm married. I've got 4 kids. I've got a very average Joe type of house. And my goal is to share what I've learned and what's worked for me over the years with other beginners out there as well. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.